Everyone, I'm Stephan&Vincent, aka Pseudo Lawyer, one of the co-founders and chief legal officer for a launch advisory firm called OpenWorld. Previously, blockchain lawyer in private practice for a number of years.
My name is Vincent. I also work at OpenWorld with Stephan on the tokenomics side. Been in the token launch and issuance business for like the better part of 3 years, and we just finished our first year at OpenWorld here.
Yeah, so I think we're gonna talk a little bit about how do you actually launch a token in 2025 amongst all of this regulatory uncertainty, market uncertainty, what's actually going on. I think sort of my goals from the legal perspective are talk a little bit about the presidential election in November, a lot of the momentum that was created by that, a lot of the hope that I think has been fleeting, quite frankly. Market structure legislation, what's Congress actually going to do? What is that going to look like? The SEC and deregulation. I think there's been a lot of people in the space, a lot of projects in the space trying to understand, what is the SEC actually going to do, especially coming off of what is sort of very chaotic Gensler era. Really interesting updates and things going on in Europe, actually, MiCA. So I think MiCA, in a lot of ways, and we'll talk a little bit about that, creates this forcing function on the US to try to get it right. There's a lot of really interesting things going on in decentralization in the US with DUNA. It's a law out of Wyoming. Other states are likely to follow, so what does that mean for decentralization and projects? And then, something I've been saying for a long time, I think the industry has probably been over-indexed on securities and securities regulations. Blockchain and crypto is so much more than just a securities regulation. So I'll sort of try to share some thoughts on what I think the focus ought to be from various policymakers and from private industry.
Yeah, okay, so I'll be focusing the second half of the discussion on kind of like a markets and tokenomics pulse check. I think when we wrote this a few weeks back, the market was in a materially different position than where it is now. So I was kind of questioning like, hey, what are like some best practices for a lot of the venture-backed like utility tokens that are coming to market maybe the next few months or quarters. So we'll be kind of thinking about, again, this like concept of like a pulse check. I have some like really interesting thoughts around like TGE valuations and sort of like the trilemma that founders need to navigate when they think about what the potential valuation range is going to be for their token at or near day one. And then we might touch on concepts around distribution and capital formation too, that tie into like the go-to-market for your token.
Yeah, so I think from my perspective, a really good place to start is coming off of the Gensler era. You have Trump winning the presidential election in November of 2024. I think at that point in time, everyone would agree there's this euphoria that sort of swept the markets. Everyone was trying to get out. Everyone was trying to launch a token. And I think from the client perspective, we had to remind everyone, and we had to remind ourselves, that nothing has actually changed. And I think if I, retrospectively looking back now, sitting here at the end of February, the same is very much true. Nothing has actually changed. Now, we have seen the SEC drop some pretty notable enforcement actions and investigations, Robinhood, OpenSea, Coinbase of note. But actually, I think that's actually added to a lot of the uncertainty that a lot of projects are facing today. Because I think what in sort of an ironic way, there was a lot more certainty about how to launch a token during the Gensler era than there is today, because you could be pretty certain that if you did anything in the U.S., or even U.S. adjacent, you were likely to face some sort of investigation, or there was the threat of that was quite real. Now, sort of post Gensler era, with Trump in office, I think there are a lot of projects are faced with this uncertainty of, well, what do we actually do? Because there actually hasn't been any formal guidance from the SEC, and dropping an enforcement action against Coinbase or against Robinhood, while good for that particular project, there's no reasoned opinion, there's no rulemaking that's actually accompanied any of that. And so we find clients very much in this perspective of, well, what do we actually do? Does that mean that we can come into the US now? Does that mean we should stay offshore? But if we stay offshore, does that mean we're not going to be able to capitalize on a lot of the momentum that was generated and that, a lot of the hope, frankly, that was generated with Trump's election? So we're finding that a lot of projects are in this holding pattern. Vincent, of course, sees a tremendous amount on the tokenomics side. I'd love to know your thoughts on what are you seeing from the commercial angle in terms of projects that want to try to capitalize on U.S. market, U.S. momentum, but seem to be sort of stuck in this holding pattern, in part because of the regulatory uncertainty.
I think what was interesting right after Trump got elected was this like made in USA kind of like narrative that was coming about. I think Move was a big one. I think Solana Labs is also like US based, and so there was this like small cohort of teams that were trying to perpetuate like this made in USA narrative, which I mean, as somebody who lives in the United States, is like very exciting, very interesting, but didn't really go anywhere because we don't know what the benefits are of being made in the USA or what the potential cons might be for teams. So it puts teams that like we work with and teams that are trying to navigate this landscape in a weird position to think about, well, hey, do we launch offshore? Do we kind of like go domestically as well? Like, so I don't really have a good answer for it because it's not clear what that means or what the benefits are of being made in the USA is.
There's a big question that I have is, do you get a sense that there is a market fatigue right now? Like, are people sort of worn out?
Yeah, I mean, I think it's pretty obvious that a lot of the capital that would be going to sort of like the middle of the pack tokens, these are like not majors and these are not like, fly by night meme coins. Like everything that would go to like middle of the pack altcoins has been rotated through like the Solana casino, now potentially through like Avalanche and through other platforms that are trying to capture liquidity from Solana's sort of fall from grace from right now. And I think a lot of like retail traders that would be bidding altcoins that would be going out through centralized exchanges or even some launches that we work with, like that capital is just not there because either it's been extracted through the launches, like high profile launches that we've seen recently, or it's just been withered away by over trading your portfolio over the last year and a half.
Yeah, I mean, I think we're also seeing VCs and sort of a lot of the sources of capital also in a holding pattern. They're particularly like projects are particularly sensitive to the regulatory developments in the United States. And if you're allocating large amounts of capital, you're going to want to have some amount of certainty that the project or the thing that you're investing is going to be in a reasonably good or reasonably safe regulatory position in a reasonable amount of time. On the fatigue side, there's an interesting crossplay between what Vincent said on the market side and also on the regulatory side. I think probably one of the biggest developments in 2025 for crypto and for having a viable pathway to launch a token actually happened in the European Union and not in the United States with MiCA. MiCA is quite interesting, and we've been studying it internally at Open World for a while. It went into effect January 1st of this year, and it is the first viable regulated pathway to offer a token to a major market. Now there are obviously some requirements, MiCA, and I think there are some mixed feelings from our projects and from some other folks that we talk to in the industry. But MiCA is essentially on its face fairly straightforward. It's a regulated pathway. It's harmonized throughout the entire European Union. It enables a project, or really anyone else. It doesn't even have to be a project. So there's a lot of portability built into MiCA. So I, as an individual, could come across a particular smart contract or protocol, and I could offer, I could make an offering under MiCA to the European markets, so long as I complied with the MiCA regulation. And the biggest compliance factor for MiCA is having a MiCA compliant white paper. What that essentially gives you as a project or as an offeror is it's a get out of jail free card, if you will. It's a safe harbor provision. So what MiCA essentially does is it says, if you want to make an offering in the European Union, you need to make a certain amount of disclosures about your project, about the token, about where the capital that's going to be raised for the offering, how that's going to be used, where that's going to go. And if you properly disclose that along with some risk factors about purchasing this token, if you get sued or if you're accused of certain wrongdoing, absent fraud or anything that that's sort of ethically or morally wrong, but sort of a large portion of the sort of classic plaintiff's actions or regulatory actions that you might face with an unregistered offering, MiCA essentially says you can use this safe harbor to get yourself some protection, and that's a really big thing. I think the really interesting thing about MiCA is its impact on U.S. regulation. In a lot of ways, like Vincent said, I'm also a very patriotic American. I think, we've seen over the last 20 years incredible amount of innovation come out of the United States. And so, but the U.S. is, I think, very much at risk of diluting its importance in the next generation of blockchain and Web3 development. So the situation we're in right now is, there is this forcing function that's been created by MiCA where there is a viable pathway now. So if you're a project, you want to make a regulated offering, you can go to the European Union, you can make that offering in the EU, and that's not something you can do in the United States yet. And so to me, that's a very real forcing function that has put the US in a pretty difficult position to try to get it right.
And you can fundraise through MiCA, right, as well with the token?
Yeah, that's exactly what it's for. It's for capital formation, and you can make direct offerings. I mean, I think you and I talk a lot about this internally at work, but I'd love to hear your thoughts on how distribution, how sort of fair launches, how that meta has sort of changed.
Well, so just piggybacking off the MiCA point, MiCA is really interesting because it's like almost a first of its kind standard, right? So it's a standard on like disclosure requirements. It's a standard on roadmap requirements, and it allows you to fundraise, right, in a generally compliant manner. And that's not something we've had previously, right? We had the ICO era previously. We've had these like fly-by-night like pre-sales and meme coins and sniping of tokens. And so it's like, to your point on clarity, lack of clarity allows for this like vacuum to happen for bad actors to extract capital from what would otherwise be going to, middle of the road packs, teams who would like to fundraise, have a good product, but need to do it in a legally compliant manner. And so when we talk about concepts around like retail fairness, disclosure requirements for tokens, like there are really no standards in crypto. Like I've read, we've probably read hundreds, if not thousands, of white papers collectively, and each one of them is just as different or unique as the other. And so and I'm not the MiCA expert here, you are, but what it sounds like MiCA can do is it can provide this disclosure requirement and standard such that there is standard documentation for teams who want to go out to market, raise from retail, and have a successful TGE in a compliant manner. And that's what's really exciting to me because on the tokenomics side, it's kind of like it's like a well-hidden secret that teams are at no liberty to disclose anything really. If you look at a lot of the recent TGs that have gone out, their documentation is very different. What you see on, for instance, teams circulating supply on one hand will be very different than what they disclose or what another team discloses separately. And the unlock schedule of the tokenomics specifically changes very, very widely, right? So if we come up with these like disclosure requirements, or at least some type of standard of accounting for tokens and roadmap and whatever else, then that'll at least help inform savvy retail investors around what they're buying, what the potential dilution effects are from supply overhangs from tokens, because I could probably point to 5 like major infrastructure tokens that have huge, unlocks at the 12-month cliff that they don't necessarily disclose, but you can see on the chart. A lot of teams like obfuscate what their token is because they have no requirement to disclose what comprises the unlock schedule and the terms of the unlock. It's very wide and varying, and so what MiCA could potentially be if teams adopt it in scale, and if it somehow gets adopted in the US, is really a step in the right direction to protect retail, inform retail, at least maybe not protect, but inform retail as to what they're buying, and give teams the opportunity to form capital in a rather compliant manner that they haven't done previously.
Yeah, I think that's right. I mean, and Vincent and I talk a lot about this, of course. I think, to my question at the top of the talk to Vincent, which is like, are you seeing fatigue? And I think you can take that question to mean a couple of different things. I think one area of fatigue that we've talked about, and I think everyone here is aware of and probably has felt in some respects, is the typical fact pattern where a project says we want to do a fair launch, we want to make an efficient offering to retail, but then when you look behind the scenes, right, it's not actually a fair launch. It's not actually a direct to market in the sense that you would think of it as. You've raised all of this VC money. You have all of these not so favorable unlocks if you're a retail, and then you're sort of building this marketing machine that sort of tries to couch the project at this sort of highly equitable, direct to market fair launch, but you don't actually end up getting that. Is that right?
Yeah. So I think people are just tired of being scammed.
People are tired of being scammed.
Yeah, I'm tired of being scammed. But and scammed is like a word that like we throw around like very loosely in this industry. But if you get scammed on like a meme coin, right, or some type of pump fund token, like that's kind of par for the course, right? Like like that's almost to be expected. But this kind of like bad acting from VC-backed infrastructure utility tokens is kind of where the disclosure requirements come into play. And what meme coins did right was they called out low float, high FDV tokens. I'm talking about the meme coins of last year, like literally right around this time, ETHDenver, like Pobcat, with like the large, like what we used to be considered blue chips, made exchanges like Binance, Coinbase, OKX call out low float, high FDV tokens, right? Because they're extremely predatory to retail investors. And where I think, hopefully where we can go for VC-backed infrastructure tokens is to really try to optimize for being on the side of fairness in terms of like retail investability. And part of that is comprised of like your launch valuation, right? So launching out, very, very high like FDV in the terms of like multi-billions, that's like the first thing that I think a retail investor is going to look at is like, am I going to bid this token at $8-10 billion FDV, right? The amount of liquidity it'll take to run it up to 2x, right, is like almost impossible to achieve, at least in today's conditions. Like, what is the float, right? Is the float healthy? Is the composition of the float actually real, right? Like, is that liquidity actually there? The treatment of like insider tokens too, like it shouldn't be allowed for teams to stake and vote like with their locked tokens, right? Because that dilutes the yield from retail, that dilutes the voting quality and the efficacy of that vote. Airdrop distributions too, right? Like if you're kind of like grinding like a protocol hand in hand with the team, the quality in which the airdrops are being distributed, I think, fray as cycles heat up, right? So yeah, those are kind of like a few things that help drive like the investability of tokens that hopefully more of the VC-backed tokens like adhere to, or at least think about deeper.
Yeah, I think our time is up, but I think some like final parting thoughts on the regulatory side, sort of in terms of like driving this to action. Look out for the SEC. I think Duna is quite interesting. It's an ability to actually wrap a lot of the on-chain activity that's happening, and also for a way for projects to capitalize on being in the U.S., made in America. I think we'll see a lot of hybrid with existing offshore structures, but also I think we'll start to see Duna become more and more prominent. And hopefully we'll look out for the SEC and we'll get some sort of sandbox rule that enables innovators to come into the space and really build something great here in the U.S.
I would also say if you're launching a token for your protocol. And we had slides too, which didn't end up here, but you can talk to us after. Yeah, it's good. Just like consider the trade-offs you make around fairness and like this new stakeholder that you'll have to kind of appease, which is the retail investor, right? Because like price is attention and attention is price. So it's really important to kind of think through that as you go through your launch and consider that third stakeholder that you didn't have previously, which is the retail liquid investor.
Thanks, everyone.